Hey everyone, that was the closing bell for the first day of December, and I didn't really get a chance to watch the markets all day. I was busy with doing some heavy analysis. So we'll get to discover how the market traded. Uh, Let's see here. Okay, so up. So this morning we talked about how if we broke in the second line. So we started out over here. I said if we broke two lines, then we could get directional. And that's exactly what we did. We were originally range bound by the second line and this first line, but we broke through it, we got directional, and we moved upwards. So let's see how significant this upward movement is. So we did pierce a local high, looks like. We already notated, but there's another one up here that we never quite reached. So let's look at it on a daily basis. SPY, we definitely came up and touched this purple line, but we still have this one, this peak over here from 2022, and then a peak above there, and then the all-time high up here in the sea green. So we're still quite a distance from the all-time high. And what we were talking about, especially in the pre-market this morning, is we're not going to get too excited if we come up and touch these first two lines. If we touch this one up here, then that's a different story. But we would definitely, it would be really, really unlikely that we would come up and touch this line without a significant pullback. So we're at this line right here. We're just going to be a little bit more wary of a pullback at this point. If we get to the second line, we're going to be super, super wary of a pullback at that point. And then once we get that pullback, then we can start talking about or thinking about moving up to higher levels. But again, we just really can't expect December to just give us more than a couple percent. So 2.5%, 3%. If it went to all-time highs, it'd be 4.5%. So in a year, that's already up 23%. And immediately after a month, that was up 9%. We can't really expect another 9% run or a 6% run. It would be very unusual to get that high of a performance twice in a row. So if we look over here, even there was a big pullback before we could run up higher. So we really do need that pullback before we can get up higher. And this was May 31st up to July 27th. So this was a 2-month run that gave us 8.67%. But November already gave us 9%. So we're really not expecting a stellar December, although it could be up, but we should pull back before we can start piercing and making those new highs. Let's see what happened in bonds, because that was putting pressure on us, and nope, that's really interesting. So weird that our bonds are trading up. I don't know, some of you might have seen a headline that I shared with you guys on Telegram channel, which was when Powell spoke today, he said that, you know what, I'm going to quote it. I don't want to butcher it. Okay, so Powell says it is premature to conclude the Fed rate hikes are over or to speculate when cuts could begin. That's definitely not what's happening over here. We are definitely speculating that cuts are going to begin and that rate hikes are over. So I don't know what this, so even higher percentage than this morning that the rate hikes are going to, or rate cuts are going to begin as soon as March. So obviously this market isn't even listening to Powell anymore. Before, whatever he said would just send the market zooming in the direction of whatever he said. But today we're just completely ignoring him, and we're saying, we don't think he knows what he's talking about. We're expecting higher or more rate cuts. So I don't think this is sustainable at all. So at some point, we're going to get the cracks in the markets and we're going to start pulling back. And it's just a matter of time. We just have to be patient and wait for it. In terms of sectors, let's see what happened. SPY is up 0.58% today. QQQ is up 0.29% today. Okay, so tech not nearly as much as the overall index. That means other sectors like most likely staples, industrials, basic materials, things like this are the ones that dragged the index higher than what the QQQ could move. And so that means the Dow Jones is probably up even higher than what Dow Jones was screaming higher, 0.84%. These two huge bars, it really broke out of this resistance right here. But before we get too enthusiastic, we need to see where we have other resistance. So we've got some right here, and we've got some right here. So this is parabolic at this point. But parabolic, consolidated, and even run up, now parabolic. So we're either going to consolidate like we did these two times, or we're going to pull back. We'll just have to see which one it is. And a likely area for us to consolidate or pull back from is this first purple line right here. So there's definitely the sector rotation that we were talking about. We are moving away from tech. So let's just take a look at some of our larger tech names, some of the Magnificent Seven stocks, and see what they did. So Microsoft, down. You can see the very clear curvature, downward movement heading towards that EMA 20. So Microsoft is down 1.16%. Let's take a look at Apple. Apple is flat. It's up 0.68%, but this is a flat movement. We got NVIDIA. NVIDIA is down 0.03%. It curved earlier than Microsoft and is already below its EMA 20. So we're seeing a lot of weakness, relative weakness in the tech sectors. And the ones that are getting strong are the ones that are in the Dow. Obviously, the index is higher. So let me just quickly check. IBM, another blue chip stock. Disney's not up, but IBM is hugely up. Another blue chip stock, Coca-Cola. Okay, that is flat. And so I could go in and dissect the 30 stocks in the Dow Jones to see what specific sectors are outperforming, but I could also just take a look at my sector scan right here today. Bonds up huge, retail up huge, home builders up huge, small cap stocks up huge. So there's some risk appetite coming in. That's a huge spike right there, breaking above the MA 200. So this is a positive sign for the Santa Claus rally into the end of the year and actually flipping into the normal progression of a bull market. So what I should say, not necessarily for the Santa Claus rally, but this is a really good sign for a bull market run in the beginning of 2024. We're not quite there yet. Again, there probably is going to be a pullback before we get there, but this is a good first signal for a bullish run at the beginning of 2024. Real estate, industrials, materials. And so these are the sectors that are getting attention here. There was consumer discretionary here as well. That's kind of interesting. But what is clear is that tech and communications are not getting nearly as much love as they were before. So we are rotating into these. Some of them are more conservative. Some of them are still growth. They're still speculative, but all of them lagged behind the tech and communications all year. So these are still laggards in terms of sectors. So they're starting to get more attention here. Well, I would pay more attention to the industrials and the basic materials. If our economy continues to do well and grow as our GDP numbers indicated, then there should be a lot more attention on industrials and basic materials. That means our factories are going to ramp up, our businesses are going to ramp up, they're going to consume more basic materials, and then the industrials are going to start getting more orders. One that I would start to think about is defensive defense sectors. So before someone asked me about defense stocks like Lockheed Martin, Northrop Grumman, those are more aerospace defense. What I thought about them, I said that they would probably get bid, but not quite yet. And so now might be the time, because what's happening is that we have conflicts that are going on in Ukraine and that are going on in the Middle East. And the US is providing weaponry, at the very least, to the Ukraine. So when the US provides weapons as support to another country, which weapons are they giving? They're giving the current supply of weapons. When the current supply of weapons is being given away in order to maintain peacetime levels of reserves, then we have to start purchasing more weapons and more ammunition. But if the drain on the supply, because it's wartime, it's faster than a peacetime supply should be able to maintain. So actually, even though the United States is not at war, if they continue to supply weaponry, they're going to have to start producing weaponry at the pace that is closer to wartime. Maybe not as close to wartime as if the United States was actually engaged in a conflict, but because the countries are smaller and they're probably not operating as large of a scale as the United States would. But in any case, it has to replenish its supplies in order to stay strong and to be able to defend itself from any potential attack. It needs to maintain its weapon reserves. So the United States will be ramping up production as the conflict in Ukraine goes longer and longer. The more likely it is that the United States needs to ramp up that production. So we can look at defensive stocks like NOC, Northrop Grumman, that's doing very well. A nice little breakout over here, or pullback, and then a bit of a breakout right here from this flat level that happened today. Lockheed Martin still chopping sideways. IAT, I believe, is the iShares. Nope, that's regional banks. What's the aerospace one? Aerospace. Magellan. No. There's a aerospace ETF. ITA? ITA. I got it backwards. ITA. Okay, wow, look at ITA. It's been on a tear even before November. So this was the associated move with the S&P 500 going up, but there was that gap up right here before. But let's just see this movement in November. Okay, this is 13.5%. The S&P 500 is only up about 9%. So this definitely outstripped the S&P 500. It outperformed the S&P 500. So this one, I would be, even though we're at, looks like all-time highs here, and that this is a very aggressive move upwards, this one I would be very interested in after a pullback. I would be very interested in ITA. Okay. All right. So in terms of other things that we're looking at, we just don't know yet. We don't have the economic counter for next week yet, or at least I can't access it yet. Yeah, I can't access it yet. So we'll just chalk this day up to a very strong start to December for the markets. Next week, we have full participation in the markets. Seasonally, it's a little bit quiet, so in terms of volume, but there's only really 2 full trading weeks, or at least full in terms of participation trading weeks in December. Those are the first 2. As we start getting into the 3rd and 4th weeks, a crap ton of people are going to be on vacation. So you're going to see that volume drop off, liquidity dry up, spreads widen out. So the movement that we see really should have, if it's going to happen on volume, it should happen in the next 2 weeks. So that's it for this week. We'll really have to see what next week brings, what the weekend brings, and then we'll be able to take it from there and decide how to position ourselves. So right now is a little bit tough because we're seeing that pullback. Yes, we do overall want our portfolio pointed to the upside, but we want to be very careful and not get too directional until we see a pullback or a longer consolidation, a breakout from the consolidation. But that's it for this week. Have a wonderful weekend, and I will see you on Monday for the pre-market review.